Many economies will face significant hurdles when pandemic-fueled liquidity begins to drain and the reality of inflation and increased interest rates sets in. But why are the market investments shrinking, and how will MENA countries hit their FDI targets? Curious to know? Let us find out. Countries in the Middle East and North Africa are competing to attract global investors and increase foreign direct investment. However, capital flows are shifting from emerging to developed countries, particularly in the United States, where interest rates are reaching levels not seen since 2018. The year 2018 serves as an example. During that time, developing markets saw significant capital outflows as international investors lowered their exposure and consolidated their risk into emerging economies with fewer perceived risks, owing to their proactive and progressive economic policies. It has always been difficult to attract foreign investors into emerging market economies. Nonetheless, because of the prolonged era of near-zero interest rates, emerging markets have been blessed with investors looking for bigger returns. The abundance of money, along with historically low rates in rich countries, prompted investors to seek better yields in riskier markets across a variety of assets, including public equities, public debt, private equity, and venture capital. Because of the cheaper cost of money, investors were able to finance projects that otherwise would have been impracticable. Unfortunately, the party has ended, and the anguish has just begun. The US Federal Reserve has begun an aggressive interest rate hike campaign, which will almost certainly be the fastest rise in interest rates since former Federal Reserve Chair Paul Volcker's inflation battle from 1979 to 1982. Many experts predict that this will almost certainly result in a recession of the world's largest economy. A US economic slowdown or recession could not come at a worse time for developing countries, particularly those in the Middle East and North Africa, where most are dealing with chronic unemployment, particularly among young and women, decreasing growth, and increased debt levels. Given the increased commodity prices, large oil-exporting Gulf Cooperation Council countries such as Qatar, Saudi Arabia, and the United Arab Emirates are better positioned. However, their lack of interest rate autonomy due to the dollar peg limits their capacity to vary from US monetary policy. Furthermore, global demand destruction cannot be disregarded as the post-pandemic increase in demand levels off, with consumers beginning to feel the squeeze from rising interest rates and inflation. This might reduce world energy demand and tourism. Inflation affects global emerging markets as well, creating a perfect storm for the onset of difficult economic times. Currency depreciation against the dollar raises the cost of imports and the repayment of foreign currency obligations for banks, corporations, and governments, many of which incurred enormous debt during the pandemic. According to research, the impact of US monetary tightening on developing economies will differ based on the causes driving the adjustment. Interest rate hikes fueled by US economic progress are projected to have a positive spillover impact that benefits rather than harms emerging nations, rendering capital flows neutral. Interest rate hikes to combat inflation, on the other hand, are likely to upset emerging economies. There are two crucial elements to emphasize here. For starters, rising interest due to inflation have a greater impact of emerging economies than rising interest rates due to growth. Second, rising economies with stable domestic conditions and policies do better and are less volatile. On a global economic climate marked by slower growth, greater capital costs, and a diminishing capital pool for riskier assets, discriminating international investors will concentrate their investments in the best emerging markets. The Goldilocks situation that markets have had in recent years is fading. Geopolitical risk, inflation, and interest rates in the United States are all rising. Furthermore, two critical macroeconomic variables will influence future capital flows to emerging markets. First, globalization policies that have previously prioritized cost efficiency and rationalization will now prioritize resilience and values-based investments. On April 13th, U.S. Treasury Secretary Janet Yellen stated at an Atlantic Council event that the U.S. would now prefer the friendshoring of supply chains to a wide number of trusted countries that share a set of standards and values about how to function in the global economy. Second, countries and corporations are putting environmental, social, and governance issues on their agendas. Consider Total, the French oil and gas behemoth, rebranding to Total Energies and highlighting its commitment to renewable energy, as well as Engine Number One, a U.S. impact hedge fund, hijacking ExxonMobil's board to pursue a green strategy at the firm. Investor interest for developing market assets is dwindling as a result of the convergence of these complex challenges on top of severe macroeconomic considerations. In the future years, it will become more discriminating. But not all is lost. Depending on the domestic conditions of each emerging economy, the outcomes and risks will differ. Considerate investors will continue to explore possibilities in emerging markets, particularly in private markets, where the majority of opportunities lie. However, as financial conditions tighten, the gap between emerging markets will widen. MENA nations may improve their competitiveness for capital by attracting and empowering strong officials to make dynamic and courageous decisions that complex changes in the global economy necessitate. Another objective should be to expand the pool of talented policymakers, promoting policies that encourage private sector development and investment, reducing government-owned enterprises, and allowing private companies to thrive and prosper on an equal playing field is vital to building a dynamic economy. Maintaining the budding entrepreneurial ecosystem. Entrepreneurial economies are consistently more resilient and result in superior long-term outcomes. Increasing regional and worldwide economic integration through bilateral and multilateral agreements with stronger economies, proactive participation in multilateral financial institutions will also improve financial stability and resilience. Policy standardization, in accordance with global norms for better regional and international integration. Investor appetite improves significantly in emerging markets that embrace developed country norms and standards, increasing transparency and decreasing uncertainty in laws and regulations. To play the game confidently and competently, investors and firms need more clarity on the rules. Several MENA countries are taking aggressive initiatives to boost their global competitiveness. Privatization projects of government-owned firms in Egypt, Saudi Arabia, and the UAE are one example of how to raise liquidity in local capital markets, promote transparency, and expand private sector engagement. FDI flows to emerging market nations surged in the 1990s, becoming by far the single greatest component of their net capital inflows. The boom in FDI to EMCs was mostly driven by mergers and acquisitions, reflecting considerable privatization of state-owned assets in a number of Latin American and Eastern European nations, as well as the sale of distressed banking and corporate assets in several Asian economies following crisis. Furthermore, in contrast to conventional forms of FDI linked with either extractive activity or labor-intensive manufacturing for exports, the 1990s saw a considerable change in a number of countries toward markets seeking FDI, particularly into the services sector. FDI flows to EMCs have recently decreased, owing primarily to lower investments in Latin America. To some extent, the recent downturn can be traced to cyclical fluctuations reflecting, among other things, global economic growth tendencies and the consequences from the technology and telecommunications bubble crash. Simultaneously, regional and domestic growth prospects have influenced FDI in chosen EMCs. Some concern has also been expressed that risks associated with FDI in EMCs, particularly those of a regulatory nature, have recently increased, as evidenced, for example, by contract abrogation in Argentina, and that in light of global economic uncertainty and increasing balance sheet pressures, a broad-based reassessment of risks could result in a corresponding decline in FDI to many of these countries. Corporate executives intend to reduce the quantity of equity and intercompany loans even further, and to have subsidiaries borrow more on their own capacity and balance sheet, both locally and internationally, while earning adequate returns to sustain internal continuous expansion. At the same time, international capital market conditions are less favorable for FDI financing since global banks have less appetite for backing FDI in EMCs due to worse global economic conditions and, in some cases, crisis in emerging markets. Several corporations have tightened their exposure to emerging economies, sought insurance against political risk, and used financial hedges, particularly when currency depreciation is expected. Companies typically recommend that profits on investment in emerging countries must compensate for higher risks, and hurdle rates have been raised in some circumstances. So what do we think about this situation? Well, those countries that keep their momentum will come out on top in the next few years. Economic problems are often followed by periods of historic successes, as history proves. And with that being said, it's time to end our video. But before that, we would like to know what are your views on this? Let us know in the comment section down below. Like this video and make sure to subscribe to the channel for more amazing videos like this one. We will see you in the next video.